corporate lawyer, and today I'd like to speak briefly about the difference between paying yourself by way of salary or dividends. So you're a business owner and you've just incorporated your business, and the first question is, how do I pay myself? And the answer is there's only two ways to extract from a corporation as a business owner. There's salary and there's dividends. Salary is paid from the top line of the corporation, which means it's a deduction from revenue. And so, for example, the corporation does $500,000 in revenue. Salary, you pay yourself $80,000. That's a deduction, just like rent, just like the goods that you are buying to sell, just like other deductions, so office expenses and all of that. Once you deduct all of those deductions, you then have your net income or net revenue, and that's the line item that you pay tax on. So if you're a small business corporation, you're going to pay 12.2% tax on your net revenue. And then your after-tax dollars are called retained earnings inside of the corporation, which I'm going to talk about momentarily. But what's important to note is that salary is drawn from the top line, which means it's a deduction on the books of the corporation. So it reduces the tax liability of the corporation because it's reducing the taxable income of the corporation, which can be a good thing. So some benefits of paying yourself salary. When you pay yourself salary, you are accessing all of the benefits and credits that the Canadian government give to individuals who earn salary. So for example, RRSP contribution room corresponds to earning salary. CCB, Canada Child Benefit, corresponds to earning salary. HSTC, the Harmonized Sales Tax Credit, also corresponds to earning salary, and so many other benefits or credits that roll out. Now we're into CERB, right, due to COVID, and so many of these, so much of the analysis relates to how much salary you've earned, not dividends. Dividends are a whole other animal and are not generally taken into account when determining these types of things. Another advantage is when you pay yourself salary, you have to deduct not just income tax, but CPP and EI. And so I call those kind of social benefit programs or social safety net programs, really. And so if you're someone who intends to rely on unemployment at some point during your life, I mean, I'm sure you don't intend to, but that's important that you've paid in so that you have that safety net later on. Or if you're someone who's hoping to receive CPP, Canada Pension Plan, later on in your life, then it's important to pay into these programs, because if you don't pay into them, you're never gonna get anything out of them. And so for all of those reasons, those are the considerations why people pay themselves salary. However, on the individual level, salary captures a higher rate of tax than dividends. And so you gain a benefit here, you kind of lose a benefit here. If the analysis is strictly, how do I pay the least amount of tax personally? It's dividends. Because dividends, you're going to receive a dividend tax credit, which I'm going to talk about in a second. But it's nuanced. Like I said, it's not just about how do you pay the least amount of tax. We look at it in a holistic way and see, well, what's important to you? Is CPP, EI important to you? Or is RRSP contribution rate important to you? And all of those other things that I mentioned. Dividends. Dividends are drawn from I'll call it the bottom line of a corporation. Dividends are drawn from retained earnings. Retained earnings are the after-tax net profit pool of a corporation. So in my example, corporation earned $500,000 in gross revenue and had all of these deductions. Now remember, in this scenario, we're not deducting salary because we're paying ourselves through dividends. So it pays its rent and it pays its goods and its supplies and internet and all of that stuff. Those are all deductions. It then pays its corporate income tax on its net revenue at the rate of 12.2% for small businesses, 26.5% if you're not subject to the SBD and it's active income. And then the after-tax dollars are called retained earnings. So now we have our profit pool. Dividends are drawn from the profit pool. Dividends can only be declared generally once a year, once that profit pool has been determined. And because dividends are drawn from an after-tax profit pool called retained earnings, they capture a lower, lesser rate of tax to the individual. The reason being is due to the dividend tax credit system. It's called a DTC. And the DTC takes into account the tax that the corporation has already paid on its revenue inside of the corporation. So you get a little bit of a credit, because otherwise the combined tax at the corporate level and the shareholder level would be astronomical. So to compensate for the fact that the corporation has already paid some income tax, you get the DTC, which basically reduces the tax for the individual shareholder. So some reasons why someone would want to pay themselves dividends is because they pay less tax, basically. They don't receive any of those other social programs, benefits or credits that I spoke about, but they pay less tax in their hands. And so obviously usually our behavior is driven by tax incentives. And so that's the primary reason why one would want to pay themselves dividends. I should note that there are 3 different types of dividends. There's eligible, ineligible, and capital dividends, and each of those will capture a different rate of tax. Capital dividends probably are our favorite dividends. They're taxed most favorably, and then we have eligible dividends and ineligible in that order. Eligible dividends are drawn from what we call the general rate income pool. It's the retained earnings income pool in which the corporation was subject to the 26.5% tax rate, which is the higher tax rate, whereas the ineligible dividends are drawn from the lower rate income pool called the LRIP, L-R-I-P. And in the lower rate income pool, the corporation has only paid 12.2% because it was subject to the small business deduction. So as you can see, the dividend tax credit adjusts itself proportionate to or commensurate to the amount of tax that the corporation had paid inside the company. So that it all evens out. There's a concept called integration, which basically means that at the end of the day, it's all supposed to even out. It doesn't. It's supposed to, and it almost does, but it doesn't when you crunch the math. Technically, it just basically means that the tax that you pay through the corporation and to the personal shareholder is approximately the same amount of tax that an individual would pay had they not earned income through a corporation. So anyways, that's a little bit about the difference between salary and dividends, and I hope that helps you determine how to pay yourself when you've just opened a business. And if you have any more questions on this topic, please contact us.